Yeah, hello, good evening, everyone. So today we start with this one accounting training. Today I will try to use the layman word, try to explain it as easy as possible for all. Let us start our topic first. Today coverage, the topic is first one is basic terminology and introduction. Second one is keeping track of your business. The third one is double entry accounting. Fourth one is understanding the balance sheet. Let us go to the first one. Let's we go for the basic terminology and introduction. What is bookkeeping? Bookkeeping is the recording, storing, or keeping the financial transaction for business and organization. Bookkeeping requires one to first understand what is debit and credit. Normally, account got one side is debit, another side is credit. On top of that, you need to understand the financial accounting, which include balance sheet and income statement. This one later on we will explain more detail for you. What is balance sheet? What is income statement? Bookkeeping is really important as it helps you to summarize your business income, expenses, and other ledgers record out to date. Here are the some basic terminology you should know for bookkeeping. The first one is balance sheet. Balance sheet, inside balance sheet got the current asset, current liability. This one later on we explain more detail. What is current asset? What is liability and equity? The second one is asset. Asset is anything that has economic value that can be owned or controlled to produce value for future economic benefit. Mostly for any form of value such as cash or stock, it considered as asset. Asset can come from tangible or intangible asset. Liability is duty or responsibility to another in return for some form of that such as business law. Liability is the money you own to bank or business loan, something like you get the loan to do the business. Equity is equal to assets minus liability. Just now we say about the asset and liability. That means you assets more than liability. That means you got the positive equity. Is liability more than assets? That means your company is negative equity. Income statement. Income statement is the financial statement to summarize revenue earned and expenses to run the business. That means normally income statement he come out with the revenue minus the cost of sales. After they come out with the gross profit. This one later on we'll show you the example. The next one is revenue. Revenue is the business you generate for product service. So the use of the investment, you put some money for investment purpose. That also called revenue. Expenses. Expenses is expenses. Expenses you to produce revenue through you sales your product or you sales your services, something like salary or you buy raw material. Accounting period normally we stand for 12 months. He can start from January to December, or he can start from April to next year, April to March, or July to June. But normally it's 12 months, depend on the business and individual needs. For provider, normally it start from January to December before for the income tax purpose. For Sendirian Berhas, they can start for any month. Account receivable at the business, you give credit to the customer who purchase a product or service from you. That means account receivable. You will receive the money from your customer, but not yet receive. So you call account receivable. Account payable is another way, is the money you owe the creditor. Means somehow like your supplier, you not yet pay them the money. Depreciation is normally very simple way is for accounting is the decline of the value, but normally for business they come with like your company own a car or your company own a machinery or equipment, the one yearly they will come with the accounting, they will do the depreciation for the asset. General ledger is the double entry, which we talk about later. They are the form to use for the account to separate the share or record each business. Inventory is the list of good or material. They be considered as the asset for the company. Journal is used to record the transaction made by a business. Whether they are credit or debit, they should always be recorded in the journal at the time and date. Trial balance is the worksheet usually prepared by end of each recording periods. The balance of all ledger are recorded in two columns, labeled as debit and credit. We also refer to the trial balance, the T account. So we go for a second topic is the before we go for second topic, got any question you all want to ask? If don't have, we will go for the next topic is keeping track of your business. Keeping track of your business account. That means everyone must do it because the account is month by month, year by year. Keeping track, you need to track your business expenses, how you're spending your money, being able to manage your business expense well, will increase the profit of your business in future. So they know where your money is going. You doing the very good keeping track of your business account. Why do we need to keep track of our business expenses? The first one is make sure we're not spending more than you earn. The second one is to get any error or mistake you can make. To set the third one is to set out a plan for emergency use. The fourth one is to know where is your money coming or going. Start to track your business account. List your income, look through statement, and list down whatever you have gained. List down your expenses. So minus out your expenses from your income. That means if you have money left over, that is your profit. Three methods to keep track of your business. Keeping track of your financial manually. Manually, that means you can use the Excel form to keep track all your transaction. Or the second one is using a finance app. Let me create a tracking system that work for you. That means more important is the keeping track of your business is consistently to make sure your record up to date. Keep expenses or budget notebook that track your spending or earning. You can also use the notebook to keep track of your transaction. You may consider translate the data from your notebook to computer. That means this one is you using the Excel to manually keep track of your business record. Double check whatever you like in your notebook. Use a computer spreadsheet to organize your expenses. Your Excel or Google Sheet are good tools for you to manage your expenses easily and effectively. Normally, if you don't buy the accounting software like the USB, AutoCount, SQL system. That means you can use the Excel, Microsoft Excel to do the keeping track of your business transaction. So you also need to analyze your finance at the end of the month. Review your record end of the month. That will help you to budget for the future. You can do anytime you can do adjustment for your budget and spending for the next month. So if you think the Excel, the method is too manual, then you can use the accounting software or you can download the financing app in the market now, wherever you can download it for free. Find the application that offer as many features as they can. They might be able to comply the data you have input easily. You also need to analyze your spending habit at the end of the month. Be sure to read the report generated by this app and adjust your spending if needed. Some apps even offer guidance on how to save money in certain areas. Track every transaction, even though it's 50 cents. Use exact figure and not rounded figure. In the account, you're doing the accounting, you need to use the exact figure. Keep track of your expenses and income as the copy receipt for all purchase and keep them in the envelope. Check your bank account regularly. Use your budget tracker to learn about spending habit and adjust accordingly. So we go for, before this, got any question or not? We go for the double entry system. Why double entry system is so important in the account system? This is the example for the double entry system. I mean, you cut purchase of equipment, the cash you need to key in the credit side. The equipment is in the debit side. The same with the credit purchase of inventory. If you use credit, that means you not yet pay the money. Inventory, you key in the debit side. Account payable, that means you need to pay money. So you key in the credit side. Credit sale to customer, that means you whatever sale you still not yet receive money, account receivable. You key in debit side. Sales, you key in credit side. That means you see the credit and debit side must be the same amount. Equity issue for cash is the same. Cash is the debit side. Common stock, that means ordinary share is the credit side. Why double entry is very important? Because every transaction has equal. That means just now you can see for the example, every transaction is the debit and credit, they have the equal amount. That means assets is equal to liability plus equity. This one later on the balance sheet there we explain to you. Double entry account system, credit are offset by debit in a trial account. Single entry accounting is used by small business to track income and expenses. Double entry is more suitable for complex business. Single story is if for sole proprietor, if you don't want to buy the accounting software, you can use a single entry accounting system. Double entry accounting system, normally if you buy the accounting software, once you key in the sales, they will automatically generate the double entry system for you. Single entry system, the inability to trade liability or asset, you might create a more errors, loss or security. For the double entry accounting is decreased error. I mean, it's easy for you to deeper, provide clear insight into the company profitability, track company financial growth, business is taken more seriously by buyer or investor. The basic double entry, that means the transaction I record as debit or credit. Like just now we show you the example, all the debit must equal to sum of all the credit amount. Standardize the accounting process and make sure the financial statement generate are accurate for easy detection of error. Normally double entry, when you key in because the system is generate, so should be no error in this the double entry system. Debit and credit. Debit is referred to, like just now example, left hand side of the ledger. Credit is the right hand side of the ledger. Total debit and credit for transaction must be equal. On income statement, debit increase the balance in expenses and loss account. We credit decrease the balance. This debit and credit recorded on the left hand side of the debit added to expenses or assets adopted from revenue, deducted from liability or equity. A credit is right hand side of the account, deducted from expenses or asset account, added to revenue, added to liability or example or double entry accounting. A company, you made a sale of 300 when recording the data, debit cash 300, credit sales revenue is 300. You decided to get loan 5,000 from the bank to be repaid in 12 months, both of the cash and liability account need to be increased. Debit cash 5,000, credit note, credit payable is 5,000 also. That means the credit and debit side must be the same. Example, like you want to buy the 2,000 laptop, debit tool and equipment, that means equipment will be debit 2,000, credit sales will be 2,000. We'll go for the next topic is understanding the balance sheet. Before we go for the balance sheet, we need go for the income statement. Income statement is the sales. That means you minus out the cost of sale. That means you will get the gross profit. Gross profit after that you minus out your expenses like selling and operation expenses, general and admin expenses, that means salary, all these things. So we come out with the operating income. Operating income, you might come out with the other income. That means maybe your bank got the interest income or other investment income, gain or loss, or other investment income, or you need to pay interest expenses. So you come out with the income before tax. So you need to pay the tax, will become your net income. This one, the net income, the amount we transfer to the balance sheet. So we go for the balance sheet. You see the balance sheet, you come out with the current asset. Normally, as asset side, we got the current asset. Current asset example like cash in the bank, or you got the inventory, or you got the debtor, they own your money. current asset. That means it's current one. Like non-current asset is the building. You got the building, you got the plant, or you got the equipment, you got the vehicle. That one is called non-current asset. So you got the total asset. So same as the liability, you also got the current liability. That means you own a credit card, creditor, tax payable, the tax you not yet pay one. This one all is called current liability. That means total you got the total current liability. After this you got the non-current liability. That means the long-term liability. That means you borrow bank from the long-term loan from the bank. So you got the total liability. Your owner equity, the capital, retained earning, and current earning. So you come out with the total owner equity. Equity plus the liability will equal to the total asset. What is a balance sheet? Balance sheet, just now we show you the example. The balance sheet is the financial document to show how much a business or a company is worth. I mean, they see your balance sheet, they know how much your company worth. Balance sheet lists down all your business asset, liability, owner equity. Balance sheet is usually prepared generally quarterly or monthly basis. For the listed company, every 3 months they need to report the balance sheet. For the Sendirian Berhad, every year you need to do the audit for the balance sheet. Purpose of the balance sheet. Balance sheet summarize a business at any point of time. It's snapshot of business finance breakdown into asset, liability, and equity. Like just now we show you the balance sheet got the asset, got the liability, and got the equity. You see from the balance sheet, you will know this business is succeed or this business is failed. Balance sheet is also important. People, the investor, the potential investor, they see the balance sheet, we know this is good to invest or not this company. Balance sheet they also can use to predict future performance. It based on we must remember that balance sheet is based on the past performance. The accounting equation assets is like just now we show you the current asset, current asset, and non-current asset is equal to liability plus owner equity. Asset category as current asset or non-current asset. Current asset example like cash, prepay, expenses, inventory, payable, security, account receivable. That means current one very fast you receive the money one. Current asset. Non-current asset like land, patent, trademark, brand, goodwill, equipment, or your machine, all those things. Liability is something a company or business owes. They are often negative in the balance sheet. Current liability within a year. That means the payroll expenses, that means like salary, expenses, rental, utility, all this one is the considered current asset. Non-current asset, maybe it's the lease, that means the loan, the bank loan, all those things. Owner equity referring to anything belong to owner or business after liability are accounted for. If you add out all the asset and subtract all the liability, the leftover is owner equity. That means your assets minus out the liability is your owner equity is your equity. Owner equity include money earning. Money is contributed to business in the form of investment in exchange of share. Earning is what the company or business generate over time and retain.